A 3% annual increase is not standard. It may be a structural misalignment hidden in plain sight, quietly destroying the value for both sides of the deal. Here's what nobody's told you yet. Your rent compounds, but your reimbursements don't. That gap between a lease that grows every year and a payer mix that doesn't, well, that gap is what destroys enterprise value between locations 5 and location 20. And when the tenant's margin collapses, the landlord doesn't win either. They inherit a vacancy. I spent my career on both sides of the table, helping to develop, lease, and scale over 100 healthcare projects across U.S. I've seen this clause destroy operators, just as I've seen it create vacancies for asset owners that cost them over 2 years of carrying cost. Today, I'm showing you the math and the deal structure where both sides can win at scale. First, the frame, because this is the part that most people miss. At 1 or 2 locations, a 3% annual bump is just a rounding error. You absorb it. Most people never even feel it. But healthcare is a margin business operating inside a fixed price ceiling. CMS sets the rates. Commercial payers benchmark to CMS. Your per visit revenue, for all practical purposes, is flat. And in some specialties, it's even declining in real terms. Now layer in a lease that compounds at 3% a year across 15 clinics. What you've built is a cost structure that compounds every year against a revenue structure that doesn't. That is not a negotiation problem. That is a structural misalignment. And it metastasizes with every single door you open. Now here's the part that most tenant advisors won't tell you. And to be honest, it's not great for developers either. But any developer who's developing a medical asset with 3% or more annual increases, well, they're underwriting a tenant whose margins are eroding every single year. If that tenant fails in year 7 because their rent to revenue ratio goes sky high, well, now they're sitting in a specialized medical office totally vacant. Healthcare spaces don't backfill easily. That vacancy can cost that developer 12 to 24 months in carrying costs, in addition to multiple 6 figures in re-tenanting expenses. Sophisticated developers understand this. They don't want their tenants overpaying the market in year 8 when they're one bad quarter from closing. They want a tenant whose cost structure is predictable and sustainable, because a stable tenant is a stable asset. The best deals are structured so that both sides can underwrite the full term with absolute confidence. Now let me show you the math. And I want you to watch this build because the compounding, well, it's the whole point. Take one location, $200,000 annual rent, 3% escalator, 10-year term. Year 2, $206,000, no big deal. Year 3, $212,000, $180,000, still manageable. But here's where compounding does its work. By year 10, you are paying $261,000 per year on what started as a $200,000 lease. Over the full term, you've paid $2.29 million in rent versus $2 million if the rent had stayed flat. That delta, roughly $239,000 per location, is pure margin erosion. Now scale that across a portfolio. 15 locations, same structure. That is $4.4 million in aggregate rent overage across a 10-year hold. Money that came out of your EBITDA, not your landlord's pocket. Okay, but here's the part that should actually make you sit up. Because rent overage doesn't just hurt your cash flow, it compresses your exit. A healthy multi-site healthcare platform may trade in the 8 to 12 times EBITDA exit. If that compounding rent clause is pulling $400,000 to $600,000 of EBITDA out of your trailing year on a 10x multiple, you're giving away between $4 and $6 million of enterprise value for free, because nobody at the deal table understood how it works when the lease was written. If you're sitting there thinking about all the leases that you've already signed, I'll tell you what most operators are doing at this point in the conversation. They're pulling the files. They count the clauses, and they realize they have 5, 6, 7, maybe even 10 locations with the exact same 3 or 4% annual bump. All because nobody on their side of the table knew to negotiate it any differently. The good news that it's fixable at renewal, at a refinance, and especially at a sale-leaseback. But only if you have someone who understands how both sides of the deal think. If you want me to look at your portfolio and map where misalignment may be hitting you the hardest, book a strategy call. The link is in the description. No pitch. We'll just do an audit. One more thing before we get to the fix. There is a clause that's actually worse than the 3%, and most operators don't know about it. I'll get to that in the end. Here's how the best deals are structured. 3 specific mechanisms. And I'm going to show you each one from both sides of the table. Because the reason these work is because they solve a problem for both the developer and the tenant simultaneously. Instead of a 3% bump, tie your escalator to CPI, or the Consumer Price Index. You can put a floor at 1% and cap it at 2 or 3%. Here's why this works for both sides. The landlord gets actual inflation protection. Their revenue tracks actual economic conditions, not an arbitrary number that overshoots or undershoots reality. And the tenant gets a ceiling. They can underwrite their rent in year 10 within a known band, not some unknown compounding rent bump. In normal inflation environments, you're paying 1.5% to 2%. In high inflation environments, the cap protects the tenant. In low inflation environments, the floor protects the landlord. Everybody underwrites a known range. That is alignment. Flat rent during the ramp. The developer gets a tenant who survives year 1, and the tenant gets some breathing room so they can build their patient base. Negotiate escalators in blocks. Say 0% in the first 2 or 3 years to protect you while you ramp up. After that, say 5% every 2 or 3 years, or 10% every 5 years. Think about this from the developer side. What is their biggest risk for a new healthcare tenant? That the tenant fails in years 1 or 2 before the clinic actually matures. A step-up structure gives the tenant a fighting chance to stabilize, which means the developer's asset has the opportunity to stay occupied. A 3% compounding clause may look good on the developer's pro forma in year 1, but it's going to look terrible if that tenant closes in year 3 or 4. Your rent is flat during the window where you're absorbing most of your costs and new experiences at the new clinic, which is exactly when these compounding clauses cause the most damage. The developer gets a tenant with a longer runway, and the tenant gets a cost structure that matches their revenue curve. Both sides are underwriting the same reality. This is the one that actually scales because you are negotiating from the center of the reality, not from just one side of it. If you own the real estate to your locations, or you're already in the process of building new ones, a sale-leaseback gives you an opportunity that most mechanisms don't do. You get to architect the escalator from the developer seat and the tenant seat simultaneously. A properly structured sale-leaseback to a net lease investor allows you to dial in the fixed bumps, say around 1.5%, or maybe a CPI collar fixed at 2%, because the investor is pricing the deal on cap rate and credit quality, not on escalator expansion. You pull your equity out of the building, redeploy the capital in your next 3 locations, and lock in a lease that protects your margins for the next 15 years. The investor wins because they are buying a stabilized healthcare asset with a strong credit tenant with predictable cash flow. You win because you freed the capital and structured a lease that protects your margin reality. That is a deal where both sides scales, not one where one side extracts and the other side endures. This is the mechanism that institutional healthcare platforms use. It's not overly exotic or overly complicated. It's just not what some generalist broker is going to suggest, because structuring from both sides of the table requires a different kind of lens. This one is buried inside your lease terms, and most operators doesn't know it exists until it detonates. I promised you the clause that is worse than the 3% annual bump, and here it is. Fair market value resets. A fair market value reset, typically hidden somewhere in your lease option renewals, says that after your base term, your rent will reset to market value. It sounds neutral, right? It's not. What it actually means is the landlord gets to reprice your lease based on whatever the market has done in the last 10 years. In a hot medical office market, that's a 20 or 40% rent hike in a single day. And by the time you hit your renewal options, the landlord knows exactly how dependent your clinic is on that location. They have all the leverage and you have none of it. Now look, I'll give you the exception because no framework is absolute. There are situations where a fair market value reset makes sense. For example, you're signing a below market rent in an up and coming or emerging submarket. Say a developer is giving you favorable initial terms to anchor a new project. A fair market value reset after year 10 may be a really fair trade for both sides. The developer took the early risk, and they deserve market participation on the back end. The calculus of knowing when a fair market value reset is a trap versus knowing when it is a fair exchange, that is the difference between operators who are just negotiating versus operators who understand deal structure. But in the vast majority of healthcare leases, the fix is simple. Negotiate predetermined escalators at every option renewal, 2% annually or 10% at year 5. Whatever fits and whatever works for you. You know your rent at year 20 the day you sign. That is site control, and that is what private equity buyers want to see. Pull all this together. Your lease is not a monthly bill. It is a financial instrument that compounds either against you or in your favor, for as long as you're in the business. The operator at one location sees rent. The operator of a 20-location platform sees a cost structure. The operator positioning for an exit sees an enterprise value lever. And the developer actually understands the healthcare real estate business, sees a deal structure that keeps their building occupied for 15 years versus creating a vacancy after year 7. The best deals aren't the ones where one side wins. Those are the ones where the incentives are aligned from day one. So neither side has to renegotiate, litigate, or vacate. A 3% compounding clause is not standard. It's a default. And a default is what people sign when nobody in the room understands how both sides of the table actually work.